Trading volume has been a standard indicator on every piece of charting software for the last 30 years. There's a very good reason for it. Volume provides you with insight into the activity of market participants at varying price levels. I believe volume analysis helps traders to become more reactionary to price movements rather than trying to predict where prices will go next. There's several volume-based indicators you will learn as you dive deeper into this course, but they all require a basic understanding of volume analysis. In this video, I'm going to show you how to interpret volume to confirm trends, find breakouts, and spot major market reversals. Let's get into it. Trading volume is the total number of shares or contracts a security traded for a user-defined session. We analyze volume to determine the intent and aggression of market participants. When trading stocks, volume will be expressed in shares, whereas when trading futures, volume will be expressed in contracts. When you buy a stock, you share in the ownership of a company, whereas a futures contract is a legal agreement to buy or sell a particular commodity or security at a predetermined price on a specified future date and time. Trading volume is calculated by simply taking the number of shares or contracts exchanged between a buyer and seller in a single transaction. For example, if you buy 100 shares of Tesla from a seller, the total volume for that transaction is 100. Buy and sell transactions like this occur repeatedly throughout the trading session. The volume indicator keeps track of all these transactions and displays them on a histogram on the x-axis of your charting software. The time period each volume bar on the histogram represents will be determined by the chart interval you decide to use. For example, every volume bar seen here on this daily chart represents a total volume traded for that day. I find it useful to add a simple moving average to the volume indicator to easily spot higher than average volume as seen right here. Personally, I like to use a 20-period simple moving average. Now that you have a basic understanding of how volume is calculated, let's look at how you can use volume to determine the intent and aggression of market participants. The easiest way to understand volume and its relationship with price movement is to think about what's happening in terms of market participation when volume is increasing versus decreasing. Volume increases as more market participants, buyers and sellers, enter the market. Volume declines as market participants leave the market. In order for a security to trend, the rising prices in an uptrend or falling prices in a downtrend must attract new market participants to enter the market. Failure to do so will lead to a trend stalling and price action going sideways or reversing. In this example, price is trending upwards and takes out the $10 handle, which is heavy resistance, notated by the number of sellers. Once price broke through the $10, new participants failed to enter the market as represented by the declining or flat volume. Simply put, not enough new aggressive buyers entered the market above the $10 handle to take the price higher. As price stalls, buyers who bought the surplus of offers at $10 will begin to liquidate their positions, driving prices down, ending the trend. In this next example, notice how when price breaks through $10 handle this time, we see new participants come into the market, confirmed by the increase in volume, and the trend continues. This process repeats over and over in every trend until price reaches a level that fails to attract new market participants. Let's take a look at some real examples. In this first example, you could have used volume to confirm the uptrend. Notice how all of the rallies are accompanied by higher than average volume, as seen here. Just as important, any retraces in the rally were on below average volume, a strong sign that the trend is still intact and will continue to rally. Similar to the prior uptrend in the last example, in this sell-off, notice how the rallies are on below average volume, as seen here, when compared to the sell-offs. You will use this information to confirm trends are intact in order to hold your positions longer or to confirm that you shouldn't be looking for any setups fading the trend. Next, let's look at how you can use volume to confirm breakouts. In this example, price reverses and begins to rally. The rally begins to stall and consolidate into a range. As price breaks out of the range to the upside, volume is increasing and above average, a confirmation that you would take this breakout setup. Once again, price begins to consolidate and we have another breakout confirmed by above average volume as seen here, providing you additional confirmation to continue to hold your position, or you could use it as a confirmation to add to your position. In this example, the market is consolidating into a wedge pattern. Notice how when price initially breaks out of the wedge, it's on lighter volume. The real move doesn't start until we begin seeing volume break out as seen here. This allows you to better time your entries and will help you to avoid chop. In this example, the market is weak and trending lower. Price eventually begins to consolidate into a range. Initially, it looks like price is going to break out of the range to the upside. However, this was a false breakout notated by the below average volume. You could look to fade this move, or you could wait until it breaks out the bottom side of the range on higher than average volume, as seen right here. Finally, let's look at how you can use volume to spot major market reversals by looking for capitulation. Capitulation is a dramatic surge of buying pressure in a rising market or selling pressure in a declining market. As a move accelerates, it will reach a point where traders unwilling to suffer further losses snowballs, leading to a surge in price as traders make a mass surrender. Capitulation can mark the end of a trend, as those who didn't exit during the panic are unlikely to do so soon after. It's a shakeout of the so-called weak hands, traders lacking conviction, and it replaces them with more risk-tolerant holders who may not have suffered losses in the recent decline, resulting in a price reversal. Let's look at some examples. Here's an example of capitulation on the E-mini NASDAQ 100. The market is trending lower and price begins to drop extremely fast, accompanied by a huge surge in volume, followed by an immediate reversal. The weak hands were shaken out of their trades and replaced with more risk-tolerant holders, resulting in the price reversal, which in this case would have been a sign to exit your position if in one, or you could have looked to get long. Let's look at one more example of capitulation. Here we have a strong uptrend which ends with capitulation as seen by the dramatic surge in volume and price. Can you spot the opportunity where you could have gotten short? Notice how price consolidates into a range and then breaks out to the downside on above average volume, providing you the opportunity to get short. When analyzing volume, it's important to be cognizant of the time frame that you're trading on. Volume will typically be the highest during the first 30 to 60 minutes of the regular trading session and decline throughout the day until the last 30 minutes of the session, when you will typically see a spike in volume. Large traders and institutions typically look to place their trades during these time periods due to the higher liquidity. This can cause a problem if you're trading on a time frame higher than roughly 5 minutes. For example, notice on this 30-minute chart how volume declines after the opening 30 minutes, seen here and here. When trading on longer time frames, you can solve this problem by using the relative volume indicator. Relative volume compares the volume of the current bar to the average volume of the bars that occurred at the same time on previous days. In this example, you could have used relative volume to confirm that the uptrend was still intact, as seen here by the rising relative volume. Now that you have learned how to interpret volume, it's important that you begin to get some screen time spotting these examples on your own. Volume analysis is an extremely powerful tool for day traders, one you can build an entire trading career around. Trading volume is just a tip of the iceberg when it comes to volume analysis. In the next video, we're going to dive into volume profiles, which will be a game changer for a lot of you. If you like this video, help my channel out and give it a thumbs up and subscribe. In doing so, I promise to continue to produce content that I'm confident will help you become a better day trader. I'll see you in the next video. Take care.